insights that we want to take a look at today. And I think you did a nice job of framing out exactly what has happened with the Federal Reserve and potentially a change in path. Derek, there's, a long-awaited meeting was this past week, and we waited for not only the FOMC meeting and, of course, their quarter-point raise, but what they said afterwards, and there was a lot to take away from that.
Yeah, there really was. And I think, it depends on how you want to approach it. You could look at it negatively or positively, depending upon your persuasion. But generally speaking, the Fed did raise the dot plot estimates just a tad over where they had been previously. A couple of weeks before, we thought they were going to raise those dot plots significantly. And by that, I mean where they thought interest rates would ultimately go to combat inflation. And, of course, the events with the regional banks over the last couple of weeks, liquidity issues and so on, basically short-circuited what was a more hawkish stance on the part of the Federal Reserve.
Yeah, and I think really what the takeaway is, what is the market saying about that? And when we talk about the market, it could either be the economics of what we're looking at, it could be the stock market, or it could be the bond market. And what I want to focus on here is what the Treasury market is doing. The 2-year Treasury at 3.6, and of course the 10-year at 3.2. That has come down significantly, and both are significantly under the Fed's rate right now.
Right. In fact, every single maturity on the yield curve is below the Fed funds rate. That's happened in the past, but in the past, when that has occurred, we have had a recession that developed shortly thereafter. So that's, I think, what the real issue is how deep a recession? Will it be shallow? Will it be 1 quarter? And given what the Fed said in their communique, they're looking for 0.4% growth in 2023. Atlanta Fed says Q1 is going to be over 2%. So that implies 3 negative quarters for GDP of the balance of this year, which also would imply 3 down quarters for job growth. And that's certainly something that will be politically unpalatable for many.
Yeah, you think about that, and you talk about, call it a 5% terminal rate. In other words, where the Fed is going to stop raising it. The Fed funds rate now at 4.75 to 5, yet signaling there might be 25 basis points yet before they pause. But when that rate is significantly above the Treasury rate, the bond market is telling you something as well. Not only will there be a slowing of the economy, but perhaps something else is amiss.
Right, and I tend to have much more faith in the bond market than a bunch of unelected officials, many of whom don't have economics degrees. So, let's just assume the bond market's right, that the economy is going to slow. Gundlach, the bond king, would tell you that when the 2 years below the Fed funds rate, the Fed is about to pause. And what we've been waiting for is that sign, that signal that the Fed has stopped hiking rates, even as they continue to do quantitative tightening through the reduction of their balance sheet. Although this is even more shocking. In the last 2 weeks, 2/3 of the reduction in the balance sheet was eviscerated because they took all those loans for deposits. So what's going on in Washington is very complicated. The valuation of the S&P 500 is 14 times 2024 estimates if you exclude the FANG stocks. So there are values out there, but the market is becoming increasingly top-heavy. We've seen the FANG stocks roar again this year, and many of them are trading at higher levels than they were pre-COVID.
2 points I want to go back to. Number one is that quantitative tightening, something that we've talked about a lot, where the balance sheet has been decreasing, as you said, spiked back up. The chart is really kind of humorous, if you will, to look at. And number two, what is happening with the banking industry further suggests that lending will be tighter going forward.
Oh, absolutely. Regional banks do most of the commercial lending in this country, most of the real estate lending. The money center is not as much. And there was a mismatch in some cases on duration with regard to the Treasury securities that they purchased to basically match their liabilities, which are deposits. So very complicated. So we spent a lot of time this week on the committee, looking at financial companies, where were the vulnerabilities. We had a scare on Friday with Deutsche Bank, the credit default swaps spike, similar to what they did with Credit Suisse prior to the week. But, by the end of the day, people realized Deutsche Bank actually made $6 billion last year.